Well, we told you earlier about Countrywide's financing. My next guest says it may be evidence of an economic turnaround, but whether the markets are really up to the task hinges on the jobs report next month, according to David Dahl. In the meantime, he has some stock picks for us as well. David, by the way, manages $2 billion, CEO of Kanaly Trust, and joins us this evening from Houston, where you got through a potential problem there with the storm. Okay, David, that's good to know.
Yeah, thank you, Mike. Good to be back with you.
Talk to me, first of all, about this Countrywide situation and what you're seeing there.
Well, I think the $12 billion renegotiation that they did today on their line of credit really is emblematic of the credit markets settling. We've seen for at least a couple weeks now the move by the Federal Reserve to cut the discount rate, the imminent move, it appears next week, to cut the Fed funds target rate. All of that shows us that the credit market issues from mid-July and early August are settling down, and it allows us to focus on some of the economic data points that are really going to be significant in the weeks ahead.
Now, my understanding is, I mean, you're looking here at what you anticipate will be a rather solid economy.
Yeah, it's our view that the credit issues have been somewhat contained, that they really haven't spread to Main Street. But as you kind of highlighted leading us in here, the jobs report coming up in 3 weeks is going to be a crucial number. When we track the jobs data through the filter of productivity gains, wages increasing, it tells us the health of the consumer. The consumer's health tells us the status of the economy, and the status of the economy talks to us about corporate earnings. All of that signals how the economy is going to play through for the markets and how well they'll do. Well, so the jobs number is really crucial coming up.
And with all that in mind, why do you get a sense that things are not going to be nearly as bad as some have anticipated?
Well, because the jobs number we saw last week was really impacted by a loss in the government sector. There's some seasonality to that with schools starting back up. I don't know if we're ready to make a call yet. We think it's a really significant number coming at us in the first week of October. But the other building block numbers for the economy, industrial production, capacity utilization, we still see strength there. We're looking at earnings that for the third quarter are going to be somewhere around 4–4.5%. We think consumer spending has hung in there. Tomorrow we get a really good gauge on that with the advanced retail sales. That's going to tell us really how back-to-school sales did a couple weeks ago and how people are setting up for the Christmas selling season. Okay,
David, let's take a look at some of the stock picks we have tonight. Yeah, I know you think investors making a mistake when they're tied too closely to one sector, and so we've got a number of different sectors here to talk about. Hess, a good time to be in oil, I guess.
Well, certainly $80 a barrel where we've closed today, but really the issue with Hess that we see and that we like for our clients is this is a company that's really close to the wellhead. It is the premier upstream player. The leverages that they had put on that contain some of their earnings for the last couple of years are falling off. We see a company that's up on a year-over-year basis, earnings around 46% when we amalgamate over the last couple of quarters. Extremely well run, not contained by refining and distribution as some of the other integrateds. Top of the peer group, PE around 12. This is just a solid company that plays into the energy space very nicely at this point.
Also, you have an entirely different sector, Tiffany, and they really benefit because aside from what's going on in the States, they're strong in Asia, they're strong in Europe.
Oh, Mike, you got it exactly right. Now, this isn't an exporting play. I mean, I think that a lot of folks would talk about exporting with a weak dollar. Tiffany has located stores outside the United States, in Europe and primarily in Asia, and this is a GDP differential play. We've got economies growing at higher rates in those areas than the United States. Tiffany's is well positioned, and in a converse kind of way, $78, $80 per barrel oil, that's the funds that is fueling consumers to spend in these Tiffany stores spread out outside the United States. It's relatively defensive because folks that are going to Tiffany to buy a new engagement ring or a beautiful bauble or watch or something like that, they're not impacted by oil so much, and if they are, they're probably positively impacted. So we see a company that's up 30% year to date. We've been invested in it a while and still see good things to come.
And before we go, only about 25 seconds here, Dell. The company's been up and down and back up again.
Indeed. Dell's a product cycle play for us. Vista that was announced and released back in February hasn't come to fruition, but we've seen a real change as they've adjusted their strategy moving into Walmart, setting up, and if we, as we do believe the economy's in solid shape, that means our consumers are coming at us in the fall and leading into Christmas, and we see good things ahead for Dell in terms of top-line revenue growth.
All right, David, we'll leave it there for now. Do appreciate it, and thanks very much. David Dahl, CEO of Kanaly Trust.